Hello and welcome back to Between the Margins with Connor. This is episode 2, Why Stock Prices Move Even When Nothing Happens. In lesson 1, we established that a stock is not just a ticker or a line on a chart, but is actually a probabilistic claim on a real business. Now, the price is not the business itself, it is the visible output of expectations layered on top of that business. So we need to address something that confuses almost everybody at first. If stocks represent businesses, why do prices sometimes move sharply even when nothing appears to have changed? This is the core confusion and one of the most frustrating experiences in all of investing. Watching a stock move extremely in one direction or the other for no obvious reason. There's no earnings, no news, no press release, no economic data output, anything. And yet the price will just jump or collapse anyway. People usually respond to this in one of two ways. Either they'll conclude that the markets are irrational or that they're being manipulated. Others might assume that they must just be missing something. Both of these reactions are entirely understandable, but both of them are also entirely incomplete. To understand why prices move even when nothing happens, you have to stop thinking about the markets as responders to events and start thinking about them as systems that constantly update their beliefs. Prices don't wait for the news. A common mental model will go like this. Something happens, information is released, and then the prices adjust. That does happen sometimes, like when there's a very binary event that plays out in one of the two ways that people expect that it might. But most of the time, markets don't behave that way at all. Prices are forward-looking. They reflect what participants collectively believe will happen, not what has already happened. By the time news becomes obvious and is widely reported, the market has already been debating it for weeks or months or sometimes years. In other words, the price you see today already embeds countless expectations about the future. When new information arrives, prices don't react to the information itself. They react to how that information compares to what was already expected. In other words, prices respond to surprises, not the information itself. Expectations matter more than the outcomes. This explains a phenomenon that confuses new investors constantly. A company will report strong earnings and the stock will fall, or they'll report bad results and the stock will rise. The mistake is assuming that the prices are moving on whether the news is good or bad. They don't. Prices move based on whether the reality was better or worse than the expectations. If a company was expected to grow profits by 20% and only grows them by 15%, that's bad news relative to the expectations, even if the business is doing well in absolute terms. Markets don't reward good outcomes. They reward outcomes that are better than the collective forecast. Most information is also absorbed long before you ever see it. Public markets are full of participants whose full-time job is to anticipate the future state of the world. They'll read filings, build models, talk to suppliers, customers, track down economic data, watch the competitors, constantly revise their views, and by the time the information filters down to the headlines, it's usually very, very old news. That doesn't mean that the markets are perfectly efficient. It means that obvious information is rarely the thing that moves the prices. When prices move without clear news, it's often because expectations shifted, probabilities were revised, uncertainty changed, or the positioning became unstable. None of these will show up cleanly in a headline. Small changes in belief can also cause very, very large moves in an underlying stock. Another missing piece is the nonlinearity of this. Price is not a smooth function of belief. It is a clearing point between the buyers and sellers at any specific moment in time. When beliefs shift even just a little bit, the balance of willing buyers and sellers can change abruptly. If there's many, many investors holding a stock for similar reasons, a small crack in that shared belief of why they're holding it can trigger a large price move to the downside. Not because the business changed overnight, but because the beliefs of all of these people holding shares for the same reason changed. This is why the markets sometimes feel very jumpy or fragile, and they are. Liquidity and positioning also matter more than most people think. At any moment, the price of a stock reflects who is willing to trade right now. The price is determined at the margin. If most investors are fully invested, there may only be a few, what I like to call marginal buyers left. If there's many investors using leverage or short-term funding, they may be forced to sell if volatility rises. In those situations, the price can move dramatically even if the long-term outlook hasn't changed much at all. This isn't stock manipulation or anything, it's just the mechanics of the market. Markets are not just collections of opinions, they're the collections of the balance sheets and everything that the companies represent, as well as the opinions of the stockholders. So connecting this back to the first lesson, Foundations 1, about what a stock is, in that episode we talked about stocks as claims on future cash flows and prices as the visible output of a longer chain. So this is where the framework starts to really matter. Cash flows change pretty slowly. Expectations can change faster than that. And prices can change the fastest of all three of those. So when you only focus on a business and ignore the expectations, price moves can feel very random. When you focus only on price and ignore the business, markets feel completely unanchored. So both views are incomplete on their own. This can confuse a lot of people at first because human intuition is backward looking. We're wired to explain the outcomes after the fact and then search for concrete causes. Markets don't cooperate with that instinct. They move based on probabilities, second order effects, shifting narratives, relative beliefs, and constraints. That makes clear expectations very rare, and in hindsight, narratives very tempting. So learning to live with this ambiguity is part of becoming a competent investor. If you're constantly looking for clear reasoning for why everything happens, you're going to be highly disappointed. So we need to stop asking ourselves, what was the news that moved this stock? And start asking ourselves, what expectations shifted? And why are the people trading in this market trading the way that they are? Because price movement reflects the expectations of surprises. It's not storytelling. So the main takeaway of this is when a stock moves and you can't find the reason, it doesn't mean the move is meaningless. It usually means that the thing that changed wasn't an event that happened, but more so a belief in the market. The prices don't respond to what happened, they respond to how reality differs from what was expected. So the difference between expectations and reality is where volatility lies. And once you internalize that idea, the markets stop feeling arbitrary and start feeling conditional. So in the next post, we're going to look at risk and why this is a very misunderstood aspect of the market and why a lot of people will focus on volatility rather than what you should be focusing on, which is more so the fragility of the market and the fragility of trades you're making. This misunderstanding sits underneath many of the behaviors that we've just described. Thanks for listening, and I'll see you in the next one.